Hi, everyone. Welcome to another episode of the LATAM Stocks Podcast. I'm your host, Patrick Flood. Today, I'm speaking with Sebastian Miralles. Sebastian is the founder and managing partner of Tempest Capital, a Mexican private equity firm. He's had a long and successful career working with private equity in Latin America. He was also a founding member of the CFA Society in Mexico. So we have a ton to talk about today: Mexico's economy, private equity, his firm, Tempest Capital. So let's get right into it. Hi, Sebastian. How are you?
Wonderful, Patrick. Thank you for having me.
No, I'm very excited to talk to you today. Thank you for doing this. So, before we get into everything, can you tell listeners a little bit more about yourself? Where are you from originally? Where'd you go to school? How did you end up managing a private equity firm in Mexico?
Oh, well, long story, but basically I'm a mutt. Each one of my grandparents was from a different country, and I've lived in 9 different countries. Grew up mostly in Mexico, and made Mexico my home. And I'm Mexican. I'm a strange Mexican.
Interesting. And then what about private equity? Did you always have an interest in finance? Was that what you planned to do for a career when you went to college?
Yeah, basically, I've been fascinated by finance and how it represents society, the interactions of society and wealth, the allocation of resources and wealth creation since I was little, actually. And we're talking about like early teens. But I did consider being a physicist. I was either going to be a banker or I was going to be a physicist. So theoretical physicist.
Did you read anything when you were young that influenced you? Was a particular book or author that resonated with you that really made you go, okay, that's what I want to do?
So for finance, not really. It was just reading daily about seeing news reports and reading about the economy and finance. I can't say that I was heavily influenced by a particular investor early on in my career. Probably the first one I read heavily about was George Soros. So George Soros and Sir Templeton. These would be the first ones that I actually read. That was my late teens.
Interesting. Yeah. So I noticed in your work too, you obviously private equity, you're at the micro level, at the firm level, investing in companies, but you also have macro thesis, right? Like your reports that we're going to talk about in a little bit. You talk about macro as much as micro.
Oh, yeah, because so we're bottom up in our investment selection, but you need to choose industries and sectors that have attractive dynamics, both from a competitive perspective, that have high ROICs, that they can maintain those ROICs, and preferably have some growth in there, right? And that you can only really do that if you do a macro overlay. So we do a macro overlay on the sectors that we find most attractive, and we go fishing in those sectors and trying to find good deals there. It's part of our process. We have our investment process, which basically goes through 3 steps. First, we look at whether, we're dealing with a good idea, which is basically that this industry, this sector has a large addressable market, that it has interesting growth perspectives, potentially barriers of entry, etc. If we check that box, then we go to see whether the company, company we're dealing with is a good company. Basically, it's well run, depending on the stage of development the company has, whether it's processes, systems, a full built out team, the culture. If it's an early stage company, then we're just looking at the founders, right? And then finally, we look at terms and conditions. For listed stocks, that's basically the price, right? All for earlier stage companies, well, we might look at the structuring, liquidation preferences, and governance terms, which are incredibly important. They're almost more important than valuation, probably more important because they're binary. If you don't have governance, you just don't go in. Period.
Interesting.
You can't, it's binary. You either have it or you don't, and you follow that process because it's very easy for you to fall in love with a founder and forget about valuations, forget about whether they're dealing in an interesting industry. So you could have a very convincing founder, a very convincing management team in a bad industry. And, they might be great people, but they're not going to make a great success in a bad industry. They're wasting their talent. Similarly, if some people like to go for the lowest cost, the cheapest option within a particular sector because they want exposure to a sector. If it's a bad company, it's probably going to be a bad investment. So no matter how cheap, particularly in early stage companies. Early stage companies are highly binary. They're cheap for a reason.
Right. So what are some of the maybe governance due diligence that's unique to Mexico? Is there anything that maybe an international investor that's never invested in Mexico might overlook when they do the governance due diligence that you put so much emphasis on?
Well, there's a lot. To begin with, in reality, Mexico is it's a private market. And that, and that's probably why we're talking, Patrick, because, there's not a lot of publicly listed stocks in Mexico. The entire nearshoring opportunity is mostly accruing to private companies. Now, so first is you're probably going to have to be dealing with private companies in an area where nominally Mexican minority rights and governance are actually relatively strong. So that's something that people get wrong about Mexico. Our laws are not that bad. The problem is enforcing them. So you might think you have first, you'll be surprised that minority investors have very significant rights built into most legal structures and by default. You'll be surprised that they're very hard to exercise, even though you have them, right? You're going to be surprised that you have a concentration of service providers, which means that if you're dealing with counterparty that's very influential, well-connected, you might actually find that it's very difficult to find a service provider that's willing to prepare material to litigate against them. And that means that, for example, this is something you need to consider when you're investing alongside influential Mexican families. It may be very difficult to exercise your rights against them if something goes wrong.
I've noticed that. You mentioned the Mexican families, and I've noticed that at least in a lot of the public equities, it's still not family controlled, but there's still significant shareholders. Is that common in the private markets as well? Are there still a lot of family businesses you look at?
Absolutely. So a lot of the Mexican listed companies are essentially private companies because they have such a low float. In real terms, they're private. Yep. And nominally, those listed companies have strong governance rights and protections for minority interests. But then you find out that, sometimes the controlling investor is doing things he probably shouldn't, right? And the boards they use the term in Mexico, honorary. Why honorifico? They're honorary because there's limited downside there's limited liability in case things go south. So fiduciary duty breaches of fiduciary duty claims in Mexico are not usually enforced. Interesting. That's why you generally have weak boards. And that's something you have to use it as part of your screening criteria.
Is that one of the reasons then at Tempest you describe yourselves as activists? So do you go in and make sure that the boards you invest in are not weak boards? Is that a key point for you?
That is one of our key points.
Interesting. Makes sense.
So at certain points, you have to be willing to get on the floor and wrestle people. Yeah.
So it's not necessarily a passive investors market. There's no more suited to an activist style, someone that's willing to be there, boots on the ground, or?
I think Mexico requires an activist fund and that to unlock value in the publicly listed company sector. So think of it as analogous to the 1970s in the US, right? Before the corporate raiders showed up and, actually put a little bit of order in US listed corporates. So you can access the opportunities and you can obviously do it through an ETF. And I would say ETF to have it well diversified. Because of the governance issues in Mexico, it does introduce an element of unpredictability. And if you're an individual investor, you can't influence that. You can't control that. So you want to diversify it away. Now, that said, it's getting better. You are starting to see corporate litigation. You are starting to see people pursuing claims against boards and pursuing claims against management teams. That is new in Mexico. It's evolving. That's part of what makes this exciting. Mexico is developing both as an economy and as a market. They're interrelated, but they're not exactly the same thing.
So let's talk about a little bit of that development. I want to ask you about your growth perspective. So in 2020, you wrote a piece called The U.S.-China Divorce, The Rise of the Mexican Decade. And then you recently followed that up at the end of 2023 with The Mexican Decade, The First Derivative is Here. So can you maybe walk listeners through what was the original piece in 2020 about? What was it calling for? How has that played out? And then where are we today?
Yeah, so it was first published in December 19. Basically, what we were seeing is that there was a necessary shift, go at a macro level, that would have a shift from supply chain efficiency to supply chain security. Basically, because the West was and is significantly, if not irremediably, dependent on China. It's not a good idea to depend for your supply chain to depend on your geopolitical enemy, your geopolitical rival, if you want to talk about it that way, but definitely not somebody that you're actually threatening to go to war with. And it never was a good idea. It was never a good idea, that type of concentration. Mexico in the 80s, early 90s was experiencing significant growth, decelerated for a lot of reasons. One of the reasons was that Mexico entered a de facto commercial war with China. So we were competing for the same markets with a very similar strategy with China, and China won. What's happened now is that China is out of the investment equation. They're definitely still there in the international trade and the international commercial market, and they will continue to be there. This is not the end of globalization. It's not possible to end globalization. What we are talking about is the more essential part of the supply chain needs to relocate to areas where security and access to that supply chain can be guaranteed. And we can talk about a lot of options, but the reality is that that's governed by proximity. You cannot control something that's across the ocean. So we use the term Mexican decade. We don't really like the term. We use the term Mexican decade. We use nearshoring. We don't like the term of ally shoring that a lot of people throw around because we don't think it covers the actual situation. I think from the US perspective, the US likes to pretend that there's a lot of options out there, but there aren't. If you invest in India, well, container ships have a very, very contentious relationship with torpedoes. They don't get along. So no, it does not give you supply chain security. China has the largest submarine fleet in the world. If you ever had a conflict with China, you'd be cut off from that supply chain. So ally shoring does not work. Proximity does. So it is nearshoring. The US would ideally like reshoring. It can't do reshoring. It has a deficit of 5 million qualified workers today. Only about 16% of US high schoolers wants to work in a factory. The US has, not completely, but it's significantly deindustrialized. And the only way to reverse that, it would be to open its doors up to massive amounts of immigration. That's politically unfeasible. We're seeing that the immigration is becoming one of the key issues for the election, and it will continue to be that. We don't see that change. Canada doesn't have a population. The only people that have somewhat available workforce and somewhat of a spare capacity is Mexico and the rest of Central America. Mexico cannot substitute China, by the way. We don't have enough people. We don't have enough spare capacity. We can only cover this essential part of the supply chain. Usually the essential part is actually also the more value add, lucrative part. So that's still incredibly attractive for Mexico. We estimate that that's going to be about $17 billion in additional foreign direct investment per year for the next decade, which will, back in 2020, we started saying Mexico is going to be growing at approximately an annualized growth rate of 3.5% to 4% over the next year. We're already there today. This year, we're slowing down, and it's kind of uneven. You know, the sovereign states in Mexico, they're growing at 6% right now. It's going to slow down this year, but going forward, we're actually upping our estimate to about 4.5% of annualized GDP growth for the next decade, next 15 years. Basically, Mexico needs to increase 2.5 times GDP in the next 15 years.
So when you say Mexico can't compete with China, are the industries you expect Mexico to be competitive in and compete with then, are those the first derivative industries that you mentioned in your most recent piece, which were automotive, aerospace, and machinery and electronics?
Let me explain that. We can't compete by population. We can't substitute China. We cannot substitute China by simply because of size. So China has an effective size of the Chinese population that lives in an area that is subject to its industrialized region. It's about 400 million people. So you're talking about 3 times Mexico. So we can't really compete. We can't substitute 400 million people. Mexico is at historically low unemployment rates. We've never had lower unemployment. So we are already in a very tight labor market in Mexico. So that's what I mean, that we're going to be picking up the most essential industries and the most necessary industries, and we're going to have a double impact. We're going to have the growth in these industries, and then we're going to have the increase in the multiplier, in the valuation multiplier. Mexico has some of the cheapest stocks, well, a little bit less cheap than they were a couple of years ago, but overall, some of the cheapest valuations for corporates across the board. Yep. So It used to be that it was possible, not usual, but you could buy a Mexican private company for 2-3 times EBITDA. You could. Those valuations are going up. We're certainly not at levels where you see it in the US at 12, 15 times, right? Which usually in the US, buying at less than that tends to be distressed territory and highly specialized strategies. There are some funds that will tell you they still do it, and I'm sure some of them can do it and do it successfully, but it becomes a very, very specialized game if you start going for those valuations. The reality is in Mexico, those valuations were available across the board if you knew where to look. They've gone up. It is getting more expensive, but we're going to have growth and we're going to have valuations. So that's a very interesting dynamic. Additionally, there's a very low availability of credit in Mexico historically. That's one of the reasons that the peso is appreciating, by the way. So a lot of people are asking, why is the peso appreciating the way it is? Well, part of it is that fundamental demand for the peso has gone up. So we have increased demand for the peso because of nearshoring.
Exports.
Less Mexican corporates are actually investing at a record level within their own plants. So CapEx in Mexican firms has gone up. So instead of families taking dividends, putting them abroad, they're reinvesting them into their own firms. Then we're having an increase in foreign direct investment, historical level of increase in foreign direct investment. And we're having a historical increase in remittances from workers. It's actually a very positive cycle that we're going through right now. That, of course, means higher demand, but additionally, very low supply. Mexican banks don't like to lend. They are some of the most profitable banks in the world, 20, 25% ROEs, and that's lending to large, very AAA clients. So basically, if it ain't broke, why fix it? They're very happy with their business, right? Their business model right now is very, very good. Some banks like BBVA. BBVA, it's not really an international bank. It's a Mexican bank. Something I believe it was 80% of their profit comes from Mexican profit. It's just a very, very lucrative banking franchise. That means that corporates, both large and small, are under leveraged. Small Mexican SMEs basically are unable to access credit almost at any price. So you come into Mexico, if you're able to bundle the companies together, get them to a certain size, sophistication, clean up some of their accounting issues, which are becoming less and less because of unlike the US, Mexico, most of Latin America, you're based in Brazil, most of Latin America now uses digital invoicing. And that has significantly improved governance and accounting across the board. It's become much, much more difficult for companies to evade taxes, to have double bookkeeping. That used to be a very, very important issue 10, 20 years ago. It's rapidly decreasing in importance, and contingent liabilities in Mexican firms are much easier to manage. Not so much the governance part that we discussed, but the contingent liability part, the potential fiscal liabilities, that's not the issue it used to be. Anyways, going back to this. So that means that it's now possible to help these companies access leverage, which means that you can also include a third value generation lever, which is actual adding lever to your investment. So it's a very attractive combination that's setting itself up in Mexico.
Interesting. So let me ask you then about the Mexican consumer. So you have this tight labor market, strong peso. So are some of the second and third derivative industries like retail or domestic tourism, have those started to be prosperous or not yet? Has it not filtered through yet to those industries?
Early stages. So, and I'm glad that you went through our paper carefully. Early stages. So the way we discussed it is exactly like that. First derivative is the direct impacts from nearshoring, and that's already ongoing, right? And we're estimating from our investable universe about $136 billion of opportunities in the first derivative of investable opportunities. The second derivative is essentially the secondary impacts, which is a little bit more on enabling technologies and enabling services that have a longer lag time. Right. And it's a little bit smaller. It's also because the sectors we're targeting, we believe that's about $96 billion in opportunities. So that's telecom, construction material, cold chain logistics. Everything that a growing middle class consumes, it comes frozen. Medicines, fruits, vegetables, meat. we're already at an incredibly tight cold chain. A lot of the product, actually, it's kind of not very good, but a lot of the medical cold chain in Mexico is deficient. And a lot of the product you're buying, particularly in the Mexican rural cities, actually would be non-conforming by international health standards. So the supply chain was broken somewhere along the line. In real terms, there's a lot of buffer built in there. So obviously, people will be taking their insulin even though they shouldn't, right? Same thing with, then the third derivative is exactly when we have that significant growth in the middle class and discretionary consumption, and that's the internal tourism. There is a little bit of that going on, but we like to think about it. The larger part of that impact is 5-7 years down the line. So our plan is to basically, we're one of half a dozen private equity firms operating in the country. What we're planning on doing is surfing the wave as these sectors evolve. That would maximize our IRR across the board and across several vintages. Doesn't mean we won't enter a sector that is from a later stage if it's the right conditions, right? Very specifically the right conditions and right pricing and in the right geographies. So that's the part where the bottom up comes in. But this helps us frame where to look. And Mexico is one of the world's leaders in aerospace. People don't know that. Fourth producer worldwide. Very similar case to Brazil, except we don't have Embraer.
Right.
We do design. We don't have the brand name. We don't have the brand name. But did you know that the Super Puma helicopters are still built in Querétaro? Did you know that the turbines, GE has 2 centers worldwide that it designs airplane turbines in the world? The U.S.
and Mexico.
And Mexico, in Querétaro. So we have a very significant aerospace cluster in Querétaro, also in Chihuahua, and it's a high value add cluster. These are not low value add services. So people might be thinking they put together some wire harnesses. No. We design the engines, which is the highest value add you can have. It's arguably more difficult than a lot of avionics. And by the way, we also have Garmin and some of the avionics providers in Mexico also. Same thing with automotive. Fourth automotive producer worldwide. We just don't have a native car brand. When we've tried, they've all gone bankrupt. We're just not good at that. So those sectors are feeling an immediate impact. The car sector has also been impacted by the strong Mexican peso. That has not been good for them. But still, our main client is experiencing an increase in middle class, in demand from the middle class, which is also what's driving a consumer level core inflation. So they're still seeing increases in their books, in their demand books. And will continue to. By the way, the U.S. will continue to experience inflation until, or at least what we can commonly define as inflation, until you solve the structural supply chain issue and start exporting inflation from China to exporting inflation to Mexico and broader Latin America.
Interesting. So let me ask you about Mexico's infrastructure then, because you mentioned in your research piece for the cold storage thesis that it's a catch-up trade, that it's lagging behind and it's going to catch up to what developed markets were. But does Mexico have the infrastructure in place already for that to play out, or is public investment into roads or ports or infrastructure necessary?
So we have historical levels of investment in ports, which is very important. There's a whole new initiative, and the new government's coming in with a new initiative on trains, which are both passenger and cargo trains. We need at least one more railroad line to the U.S. There is a huge issue on electrical generation and transmission. The number one issue is probably transmission. So what I've heard from sector experts down here, we've heard that the problem is relatively easy to solve. About $5 billion in investment will resolve most of Mexico's transmission issues, which is basically getting the transmission lines interconnected. Generation is a harder problem to solve. That, I'd love to see nuclear in the equation, and there's some talk of including nuclear, which I'm a big fan. The reality is that it's going to take time. Nuclear takes time. Thermos, combined cycle plants take a little shorter, which means we're probably going to see a lot of patchwork, a hybrid electrical grid with a lot of solar, and it will be a patch. And the new administration that's coming in appears to be very open to very amicable to reopening the energy sector to investment. AMLO, it was his whipping horse. He was all about energy, the energy in the public sector's hand. That phase seems to have shifted and to have been left behind in Mexico. By the way, the Supreme 45 days ago ruled that AMLO's modifications of the energy law and everything he was trying to do, essentially increase government control on the electric sector, was unconstitutional. So it's all thrown back.
Gone.
It's gone. We're back to where we were 6 years ago.
So you mentioned
from a regulatory perspective.
You mentioned the incoming administration. Mexico does have an election this year. So
Yeah.
is there anything that investors should keeping an eye out for if they're not following Mexico closely? I mean, what are your opinions on the coming election this year from your perspective?
Well, from my perspective, I'm much more concerned about the U.S. election than the Mexican.
Interesting. You think that is from an investment return perspective, you think the U.S. election will have a bigger impact on your portfolio companies than Mexico's election?
Yes and no. Obviously, Trump is going to be led. Trump is a racist that doesn't like Mexicans, and he's treated us that way in the past. But this thesis, the nearshoring thesis, does not depend on an individual president.
Mm-hmm.
It's really much, much bigger. That's what's interesting about nearshoring. This is not some type of hype and short-term trend. This is a secular, long-term, fundamental growth phenomenon that's backed up by geopolitical imperatives.
Yep.
Now, what would concern me regarding the evolution of the nearshoring trend if the U.S. and China decided to make up and become friends again? That would be very concerning for this trade. That's the downside risk for this trade. I see it as I identify it as a risk. I see it as a low probability risk. Mm-hmm. So whichever U.S. administration comes into power will have to deal with the situation with China. And they only really have one option. What we discussed, they may like to use the term ally shoring, but that's not solve their problem. There's only one real solution. Trump coming in will add hiccups to it, but won't change the fundamental trend. Now, the U.S. election is going to be very contentious. There might even be violence in the U.S. First time I've never thought it was possible, but I think there could be violence, much as you would see in a Latin American election. I mean, the U.S. election is looking a lot like a Brazilian election.
Right. Yeah. It's crazy to see. It really is. It's hard to believe, but I tend to agree with you. I think it's going to be, at least in my lifetime, the most contentious election by far.
So this is the most contentious period in the U.S. history since the Civil War. It's not ready at that point. I'd say we're something like 1840s U.S. The U.S. needs to take a step back, relax, and decide what its priorities are and really reflect on the road it's taking. But that said, Mexico, there's a very clear lead for Claudia Sheinbaum. I would be incredibly surprised if she doesn't win. The polls are quite clear. I think the big question for investors in the business community, what's going to be the makeup of the Congress, whether she's going to have majority control or not, the governorships, and also whether Morena will continue as a unified party. Because in reality, you're seeing a lot of conflict in that party. And historically, the Mexican left has bands together and then fragments.
Right.
So it's very possible that happened with the PRD, where AMLO was one of the founding members, and it ended up being what we call the tribus of the PRD, and essentially little parties within a party. That gives a very similar effect to having multiple parties. So the reality is the party's already fragmenting. Is it going to fragment more and more clearly? That's important because that means that power is going to be split amongst a wider group. And that's a good thing. That's a very good thing. It means that the president doesn't have as much power to impose his agenda. He has to actually go back to traditional politics and debate and negotiate. So I think what investors need to watch out is what degree of a fragmentation in Morena will we be seeing? How much diversification of the power base in Mexico will have? But otherwise, it's very clear the winner, again, I would put it at something, my personal estimate, about 90% probability that we're going to see Claudia Sheinbaum as president. She has a more business-friendly attitude, the more predictable, and she's coming in with experienced team. It's basically you're graduating the team that ran Mexico City to running the country. That's a good thing because it means that they're accustomed to working together and they have experience. There is some concerns that Claudia Sheinbaum historically has been convinced leftist. So think about her kind of like a French left. We're basically bringing in the French left president.
Somewhat ideological. Is that the worry that there's some? Yeah. Okay.
So AMLO was not a leftist. People got that wrong. He was not a leftist, especially people who say was extreme left. Absolutely not. AMLO was a populist. So he was a very pragmatic populist, by the way. Sheinbaum is much more institutional, but she's ideologically center-left.
Mm-hmm. Okay.
And her team is center-left. So one of the things you're going to see, she's a doctor of renewable energy. She's apparently bringing in people close to her to run the energy sector. So yes, we're going to see more renewable energies. Socially, you're probably going to see more programs that are more structured programs for more structured social programs. So I would expect them to actually increase, but to be more structured than what AMLO put in place, which AMLO put them in place basically for electoral purposes.
She's actually going to administrate them and make them effective.
But increase them. So I don't expect her
to, of course.
Yeah, don't expect her to reduce the deficit. I am not expecting her to do that. I am expecting her to be a little bit more institutional, but ideological.
How that plays out, like you mentioned, has a lot to do with the Congress and what happens with those elections.
Precisely, Patrick. That's why the makeup of Congress is so important.
Interesting. So maybe international investors then should be focusing more on the congressional elections in Mexico than they are on the presidential election.
Yep. That's the real game.
Well, that is good to know, I'm sure. So let's transition a little. I want to ask you then about private equity and mergers and acquisitions, and then let's talk a little more in detail about Tempest. So can you just tell me then, how has the nearshoring trend affect the private equity industry in Mexico? Has it become easier to raise capital for firms? Have you seen new firms starting to pop up, more cross-border M&A? How have the last few years played out?
All of the above, but in different degrees and less than people believe. It's at an early stage. What we are seeing is a lot of European, American, and some Chinese corporates coming in as strategic buyers.
Okay.
So what's moving is strategic acquisitions, and significantly. If you ask Mexican businessmen, industrialists, they'll tell you they've never had more, their books have never been more full, they've never had more sales, and they're operating at full capacity. For private equity, what we're seeing is increased interest in the sector. Now, we're coming from an incredibly low base. Mexico was a dirty word for investing just 5 years ago, even 3 years ago. And people want to understand the story. We're getting, for example, the articles that you mentioned, we're getting a lot of traction on them. Our first article got 1 million views on when it was referenced in Forbes. People want to understand it, but they still need to get through a lot of hurdles. Because Mexico is not institutional grade, they have to rethink, retool their investment policies. And they have to get over some long-term held biases.
Yeah. I find that in a lot of Latin American countries, that cultural perceptions stick with investors. Colombia is still Pablo Escobar. Mexico still gets associated with the cartels. Even though it has nothing to do with modern day investing or the markets, but it is what it is.
It is what it is. The best advice I could give to international investors is come to Mexico City and Monterrey for a week. Just come down.
Yep.
Come down. Right now, Mexico City is safer than New York.
Yep.
Walk around, and people will tell you, it's not just Condesa Roma. Walk around Mexico City.
And if you're a foodie, you'll find world-class restaurants. If you like history, it's amazing how well Mexico outperforms tourism-wise too. Compared to the rest of Latin America. I mean, it's like 21 million international tourists a year. So yeah, there's definitely cultural exchange. So if any country in Latin America has the ability to break the stigma, I would bet on Mexico first.
I'm a big believer in Latin America. A big part of my career has been spent on developing private equty, venture capital ecosystems in Latin America. So big believer in the future of LATAM. It has significant issues, but the world, we are right now in a very complicated world with very complicated investment decisions. And then within that framework, Mexico, Latin America is the least dirty shirt. What's the analogy? So when you're on a trip and you stayed an extra day or two, and suddenly you have a big meeting, suddenly you're invited unexpectedly, and you're out of clean clothes. So what shirt do you put on? The least dirty one. Yep. You're out of clean ones. So right now, that's the situation with Mexico. So Mexico has warts. It's not perfect, definitely not perfect. But what are your alternatives? Europe is at war. You're not only at war, it's losing the war. That's not a good place to be. And it lost access to cheap Russian gas. And to regain it, it pretty much has to reach a very unfavorable peace with the Russians. It also has an inverted population pyramid that is very scary.
Yep. The demographics in LATAM are a huge story that don't get talked about. Even when you look at China compared to Mexico, over the next decade, the demographics favor Mexico.
Absolutely. These people are underestimating the impact and the risks associated with inverted population pyramids.
Yep. And it's not that the demographics are great in Latin America. It's like you said, it's the least dirty shirt, right? They're still below replacement birth rates in most countries, but less
Barely,
so, and it's younger than the alternatives.
Yeah. When people talk about climate change, I basically tell them, boy, this is not an issue we need to deal with right now because it's already solved. Even if we assume that the science is 100% resolved, I don't think it is, but let's say it is. Let's assume it is. We are going to have half as many humans in 80 years as we have today. It's just because the population pyramids. So this is almost inevitable. How we're going to pay pensions, how are we going to take care of this aging population? I don't know. The impact it has on an economic system is a deeply deflationary impact. How are we going to resolve that within our economies? How is massive deflation in the future going to be dealt with? I don't have the answer to that. It's very complex issues.
Yeah.
Looking ahead.
Yeah. So I tend to agree with everything you just said. I think it is the least dirty. I think one of the things that's most interesting too is Latin America might be the most underfollowed region out of all the majors. If you put South America or Latin America's economy and combine it, it's the third largest by GDP in the world. But I think maybe per investment analyst or per fund, however you want to measure it, I think it might be the most underfollowed and underinvested.
Well, let's start with the basics, Patrick. We call it LATAM. We have this enormous region that's very different.
Yep.
That we just group it together because it doesn't matter.
Because no one really follows Ecuador. So they just kind of throw it in there with the Andean region. And yeah, I agree.
I tend to believe that Latin America is really 5 regions. But if you want to put it in regions. But the more importantly is that you hit the nail on the head. We just group it together as something that is not worth following. And that's because, investors follow success stories. Yep. And they're really focused on near-term, they're short-term oriented, and they're oriented on success stories. And Latin America has not delivered them historically in the near term. So until those returns become self-evident, they're not going to dedicate the resources to following the region, which makes it more attractive if you want to be early, though your IRR might be hit by the fact that you're too early. Right? It's always whether being early is being late. But right now, the issue is that they're not following it because there's not the lack of success stories. And the second one is because most of the transactions are private. So there's no product to sell. Analysts get paid for selling research on investable assets. If you can't invest in the asset, there's no incentive to prepare research for the asset.
I write equity research on publicly traded Latin American stocks. And if I only covered the ADRs, I'd be out of companies in a year. I would have covered them all. There's maybe 30 Brazilian companies, and yeah, you hit the nail on the head. There's not really a monetary benefit to covering it. I mean, in Brazil, there's an industry, there's an equity fund industry, but they don't have that much under management, and you don't get paid that well to do it.
Completely. And you have relatively low floats and relatively low volumes. And at least in the case of Mexico, most of the float is being held by Afores, so Mexican pension funds, and they buy and don't trade. So they're not big consumers of research.
I mean, that's one of the reasons I wanted to start doing this podcast, interviewing someone like you, because I'm always so interested when smart guys that do investments choose to focus their career on Latin America. Because you could have very easily, when you were 25, whatever, finished your MBA, 30, gone to New York City, ended up covering NVIDIA or General Electric and made a lot more money monthly coming in, right? But you take the long bet on South America, and yeah, I think it's going to pay off in the long term. I'm sure it has. But I also think it's more worthwhile. It's more exciting.
Much more exciting, and the challenges are much more interesting. So always have dealt with difficult zip codes. And I think that makes you a better investor. Certain Esteves from BTG, when Silicon Valley Bank went bankrupt, he made a very accurate observation. Any mid-weight Mexican, Latin American investment banking analyst would have told you that this bank was facing incredible risk because of the scarcity term mismatch between its deposits and its liabilities. Its assets and liabilities, sorry. The asset liability mismatch was so enormous. Yeah, because we've experienced that. We watched that. We're accustomed to volatility. This is something new for a lot of geographies. We'll start, and we are going to be converging in volatilities between the U.S. and Latin America and emerging markets, especially when we get over the big tech bubble, right? The Magnificent Seven. I mean, these are flat. The analogy to the dot-com bubble is
it's crazy. Yeah, it's I don't know what to do with it. Can it double again? Probably, but I don't know.
You're dealing with something that's irrational, so anything can happen.
Yeah, I think it's more meaningful too. You have more of an impact when you're the only analyst covering a company. You're the only person that's going to do a private equity investment in a region. You can really see the impacts. Whereas, who cares if you're the 40th analyst covering, Lululemon or Target? The world doesn't need another one of those.
I was an anchor investor first institution investor for a Brazil tower company. That company now has, I believe, 1,400 sites in Brazil, that mostly in rural areas and poor areas of the country. So it's helping change people's lives.
Yep.
So when you deal in emerging markets, you have actual ESG. You are actually helping people.
Yeah.
That's something that doesn't really get through to a lot. So yeah, I much rather be dealing with interesting challenges than trying to hype NVIDIA and the latest scam coin.
Right. So let's talk a little more then about Tempest. You mentioned one of your investments in the tower company, but let's talk then about
that was Brazil. That was when I was in CAF. When I was running.
So
when I used to do Latin American private equity.
So now, are you exclusively focused on Mexico now? Do you still look outside in the wider region?
Very selective. Right now, the thing is the nearshoring opportunities.
It sounds like you have enough. It sounds like you have enough.
It's too much on our plate right now. But we used to absolutely cover Brazil, Colombia. We even did certain deals in the Middle East and particularly on advisory in Middle East and Europe.
So tell me a little more about the investment criteria then. You mentioned middle market. So how do you define middle market? Specific industries? Are there specific deal structures? Equity only? Do you do mezzanine financing as well? Tell me what your filter looks like.
Well, basically, so we do two things. We do single deals, and then we're also do minority interest in smaller companies. So for single deals, we look for companies between $50 to $150 million. Equity tickets up $50 to $150 million. Control very traditional sectors. We like to define it as cheap cash flows with potential of growth. Right? We're value oriented. Even though we do have a little bit of VC DNA, I ran Mexico's largest VC fund at one point, very successful in a few unicorns. I hate the term, but a few unicorns. And you can do value in venture capital, by the way. Following our methodology and the way we think through it, we apply that even to early stage, but it's the framework. So we're looking for companies in very traditional sectors right now: automotive, aerospace, cold chain, telecommunications, value-add agriculture. Healthcare, though healthcare is beautiful. It's just expensive. Yeah, you have to be willing to pay for it. That's a sector that's very well covered. And some of the sectors that we're seeing that eventually we think there's a room for a luxury play in Mexico further down the line. We think that there's going to be increasing demand for construction materials and specialty metals, different ways of playing that without actually going into commodity businesses, but high ROIC service providers. And of course, in manufacturing enabling services.
Interesting.
So picks and shovels. So in this boom where everybody right now is investing in industrial real estate, we don't want to invest in industrial real estate. We want to invest in the people who are going to serve the factories that are going to be in that industrial real estate. Mexicans love real estate. It's kind of like a Hispanic thing. You'll see it all across Latin America and Spain. People love investing in bricks, in ladrillos. So for the minority interests, we're looking for tickets about $10 to $15 million, and those can be 30 to 40% interest. Influential minorities. So minorities with governance terms and rights. We always look at having these strong governance rights, and oftentimes as structured equity. So a lot of preferreds.
Okay.
We are willing to give up upside if it lowers the downside.
And what about debt financing? You mentioned that you can now do that, but do you do that at the company level? Or will the firm also lend to portfolio companies?
So I think it's a sector we were very cautious about. Because of the governance implications, it's hard to execute guarantees and execute on collateral in Mexican debt. So you have to have a lot of specialized knowledge on how to form, segregate, and document collateral, and what collateral can be accessed effectively. We need more knowledge on that to feel comfortable operating there. Yes, we have worked on mezz in the past, but because we have enough knowledge to be careful,
right?
To be cautious. Right. And a lot of the private interest in private debt, it's driven for the wrong reasons.
Right? How so?
In the US, a lot of it is just distressed debt disguised as private debt. So a lot of it is lending to companies that are already over-levered, participated by large buyout groups that don't want to write down their investments. So, they're just not selling them. And instead, they're putting in some debt that will eventually eat up the company. Lend to own.
Keep rolling it over.
Let's extend and pretend.
Yeah.
Extend and pretend, raise a couple new vintages, and they'll just pass it off as a very bad vintage. Meanwhile, through, asset, NAV loans, et cetera, they're providing some cash flow to their investors. But overall, that's going to be destructive of the value of the fund. So it's going to be a very bad vintage. And this boom in private debt is, to a large degree, is coming from that. At least that we identify it that way. We also don't think it's very healthy. Some of the interest, private debt in the US is asking for 17% returns. That's equity. If you accept, there's a negative selection bias there. If you accept that, you're either a very bad company or you're a company that has a very particular short-term problem that you're going to repay this debt as soon as you are able to, which means that as a fund, you have a prepayment risk, what's called prepayment. You're a CFA, Patrick, you understand the term, prepayment risk. So the negative selection bias in these portfolios long-term is bad.
Yeah.
And more so in Latin America, because importing that phenomenon to Mexico, into Latin America, where there's a lot of companies that, banks didn't lend to them for a reason while knowing them very well. You have to have a lot of knowledge of the company to be able to figure out which ones are the ones that are creditworthy and what is the correct interest rate that doesn't generate that negative selection bias. And I don't know if everybody's doing it correctly. I'm hearing some stories that we're going to end up with, in 5 years, we're going to have a lot of workouts. And I don't know who's going to work them out because...
Or defaults, right? If they don't work out, they default.
In Mexico, for example, you see a lot more workouts. You default. Yeah. But because it's so hard to execute on guarantees, et cetera, there is Mexico is a signatory to the insolvency protocol, internationally, protocols. But it's very different from the U.S. So unless you actually find a way to take your litigation to the U.S., you're going to do it under Mexican laws in concurso mercantil. It's not that slow, but it usually ends up more like a workout than a traditional U.S. Chapter 11. So sometimes they just, save themselves the time, work it out, write down the debt, and refinance it. Who's going to do it? Because there's not a lot of professionals. And when you have a fund that's underperforming, the professionals tend to leave. So now you're going to have a zombie, and a zombie that somebody has to manage. And I don't know who that person is going to be.
Interesting. So I want to be respectful of your time. We've gone for an hour, but I'd also like to ask you about Clip, if you want to spend 5 more minutes. Can I?
Sure.
Sure.
Clip.
Yeah. So tell me about Clip. It was a portfolio company that you've exited. So can you maybe just walk me through the thesis, how you made the investment, and then why you chose to exit?
Okay. So this was when I was in Mexico, running Mexico Ventures. Basically, we came in, Clip is the square of Mexico. So card-present transactions, Mexico. Mexico, like most Latin America, severely underbanked and completely disproportionately to GDP. Huge problem on cash and card acceptance and the excessive use of cash. So we had this problem. We also had these transaction fees that were very, very high and was ripe for disruption. It was also a sector that had significant barriers of entry if you're able to achieve critical mass. So it checked the boxes on a sector I wanted to play in.
Mm-hmm.
Then Adolfo, Miriam, some of the best entrepreneurs in the sector in all of fintech in Mexico, maybe Latin America, very focused on product and quality, which is something that resonates with us. We like businessmen, we like entrepreneurs that focus on excellence, on producing excellent products that sort of sell themselves. You still have to have the ability to sell, but if you have a bad product, eventually it will catch up with you. So Clip was focused on excellence in operational excellence. So it clicked our second box. Then the price was ridiculously low compared to international comparables. So came in, I was a board observer for a year and a half, then asked to come down and become CFO of Clip. And I was CFO of Clip for 6 months, raised their Series B. General Atlantic came in. We were able to raise 3 times the money at a significant up round to at the time we could. And so it resolved all the operational issues. Kind of interim CFO, getting everything in line and, nice and institutional quality. And so afterwards left, was well rewarded in equity shares, and then sold them to SoftBank. Because when SoftBank comes in, you sell.
Right. So
when the buyer of last resort comes in, you sell.
SoftBank bought the whole company? They came in and they bought out existing shareholders?
No. They came in a Series C and did a secondary.
And where is Clip today? Are they still...
Clip is the leading fintech in the country.
Okay. So they're looking at listing.
They're looking at listing. And, I can't go into details on potential valuations. I know they're looking into it. Let's see when they're ready.
So I'm curious, and that brings up one last question then. When a Mexican company looks to list, how attractive is the local Mexican stock exchange compared to doing a listing directly in the U.S., like some Latin American companies do?
Less attractive. We just had an example. So we had Tiendas 3B just listed in the U.S. for, I believe, $4.5 billion, and valuation skyrocketed upon listing. So there's real appetite for Mexican equities right now. It's somewhat structural. This difference is structural. It's really about the appetite of participants in the local market. So basically in Mexico, most of private savings are with the Mexican pension funds, the Afore system, the IFP system that is prevalent throughout Latin America. They're buying whole. They so there's not a lot of liquidity in the market. There's obviously a discount because there's lack of liquidity. They tend not to intervene that much in governance. So there's also a discount on governance that reduces valuations. And this market that kind of makes this low volume market makes it a little bit unattractive for international investors to come in locally.
Right.
So they just go through ADRs and international listings. You can delist a Mexican company, relist it in the US, and get a 2x. Which is why a lot of companies delisted.
Yeah. They start by doing the ADR, right? So they'll list in Mexico, do an ADR, and then just delist in Mexico. Is that the playbook?
And if it has low float, mostly held by the family, you can't blame them. It's basically a cost of capital issue. Cost of equity in Mexico is higher.
So if you can raise it at half the price in the US, why not?
Why not?
Yeah. Interesting. And the shareholders don't care, right? Existing shareholders aren't going to complain. They get an immediate write-up. So, I guess it's just Mexico's stock exchange that loses, right?
That's correct. And it also means that companies that don't have access to U.S. listings, it's a little bit harder for them to raise capital.
They're at a competitive disadvantage domestically.
Being an SME in Mexico is a pain. It's a pain worldwide.
Yeah.
You're dealing with a lot more
headaches, but... Well, this was a fascinating conversation. Thank you again for doing this. So where can listeners learn more about Tempest, follow your work, LinkedIn, Twitter, Instagram? Where are you?
We are on all of them. So you can find, except Instagram, you can find us. You can find our website, www.tempestcapital.com. You can register for our newsletter there. You can also register and read our most, not all our articles that are posted in behind. It's not a paywall, but it's a members wall. So you have to register. We have to accept you, and you can go in and see it. And we're quite Googleable, so you can also find quite a few of our opinion pieces over time online.
And I will link all that in the show notes for anyone that wants to find it easily that's listening. Thanks again, Sebastian.
Thank you, Patrick.